The Bitcoin bottleneck. Bitcoin's role as digital gold is secure. Nobody's arguing against its position as the crypto reserve asset. But the generational wealth analyst highlights a constraint that Bitcoin maximalists avoid discussing. Speed makes Bitcoin unusable for the transaction volume a $72 trillion wealth transfer generates. Here's the mathematical reality. Bitcoin processes roughly 7 transactions per second. That's 604,800 transactions daily at maximum capacity. During bull markets, this limitation creates fee markets where users compete by paying higher fees to get transactions confirmed. We've seen Bitcoin fees exceed $50 during congestion, making small transactions economically impossible. The analyst uses a perfect metaphor. Bitcoin is a single-lane country road. Every transaction queues sequentially, waiting for the previous block to confirm before the next begins processing. This design prioritizes security and decentralization, which makes sense for a store of value. But it creates fundamental bottlenecks for medium of exchange functionality. Consider the practical implications. If institutions need to move billions daily, if merchants need instant settlement for point-of-sale transactions, if DeFi protocols need high-frequency trading execution, Bitcoin's architecture physically cannot support these use cases without layer 2 complexity that reintroduces centralization risks. The $72 trillion wealth transfer isn't a single event. It's actually a decade-long flow from baby boomers to millennials and Gen Z. That money needs to move through financial systems, purchase real estate, fund businesses, and, change investment positions. Every transaction requiring Bitcoin's base layer would create congestion that makes the network unusable for anyone except those paying premium fees. This isn't criticism of Bitcoin, it's just recognition that different use cases demand different architectures. Gold doesn't move quickly either, but that doesn't diminish its value as a reserve asset. Similarly, Bitcoin's slow settlement doesn't undermine its position as digital gold. It just means something else needs to handle the transaction velocity that wealth transfers require. KASPA approaches the speed problem through BlockDAG technology, a fundamentally different architecture than Bitcoin's sequential blockchain. Instead of processing one block at a time, KASPA confirms multiple blocks simultaneously through its GhostDAG protocol. Imagine turning Bitcoin's single-lane road into a multi-lane superhighway. That's exactly how the generational wealth analyst describes KASPA's transformation. Right now, KASPA processes 10 blocks every second, with transactions settling in about 10 seconds. When you compare this to Bitcoin's 10-minute block times, the difference in capacity becomes quite obvious, doesn't it? So, here's what's technically significant. KASPA manages to maintain proof-of-work security while achieving speeds that you'd typically think require proof-of-stake centralization. Now, this is important because proof-of-work offers the censorship resistance that institutions really need when they're moving large values. KASPA didn't sacrifice security for speed. It actually redesigned the architecture to enable both. The academic foundation really does strengthen credibility here. Dr. Yonatan Sompolinsky, the mind behind the Ghost protocol cited in Ethereum's white paper, is the designer of KASPA's consensus mechanism. So this isn't some experimental tech from unknown developers. It's peer-reviewed research that's been applied to actual production systems. So, current network performance really validates the design here. Transactions confirm almost instantly and with minimal fees, no matter how busy the network gets. During times when Bitcoin users might be paying like $20 to $50 per transaction, KASPA actually maintains sub-cent fees. This kind of cost structure makes microtransactions totally viable. Think paying for coffee, tipping content creators, or settling small invoices, all those use cases where Bitcoin's fee market just creates these economic barriers. The roadmap expansion into smart contracts through layer 2 solutions like KASPA'S adds programmability, but without sacrificing base layer speed. This kind of positioning could enable DeFi applications, tokenization platforms, and even enterprise systems, all while keeping the main chain optimized for transaction throughput. If this infrastructure analysis is revealing capacity constraints that mainstream Bitcoin coverage deliberately ignores, you need to smash that like button immediately and subscribe to TJ Crypto World. I deliver these technical deep dives daily because, honestly, the space is just saturated with price predictions that ignore whether networks can physically handle their projected use cases. Your engagement tells me you're ready for analysis that measures architectural capabilities, not just market sentiment. Now let's examine the fair launch element that either validates KASPA'S decentralization or, proves irrelevant compared to established networks. So, let's talk about KASPA'S launch mechanics for a second. The generational wealth analyst really emphasizes that KASPA had a fair launch. There was zero pre-mine, zero pre-sale, and absolutely zero insider allocations. Every single KS coin entered circulation through mining, which honestly created a distribution that's pretty similar to Bitcoin's early days. This is important for a few reasons. First off, it eliminates the supply overhang that you see in a lot of venture-backed projects. There aren't any insiders sitting on massive allocations, just waiting to dump on retail buyers. So, price discovery actually reflects real market dynamics, not some unlocked schedule or insider profit-taking, which is, a pretty big deal. Second, fair launches tend to attract communities that are focused on long-term development, not just quick speculation. When folks mine coins or buy them on open markets, their psychology is totally different from airdrop farmers trying to game referral systems. This kind of approach really helps build resilience during bear markets, unlike those communities that fall apart when free token expectations aren't met. Third, fair distribution aligns with decentralization principles that institutions increasingly value. After watching proof-of-stake networks face centralization concerns and regulatory scrutiny, enterprises evaluating blockchain infrastructure prioritize genuinely decentralized options. KASPA'S launch mechanics support this positioning. However, and this requires honest assessment, fair launch alone doesn't guarantee success. Plenty of fairly launched projects failed because technical excellence doesn't automatically create adoption. Network effects, exchange liquidity, developer ecosystem, and institutional recognition all matter as much as launch mechanics. KASPA'S fair launch provides credibility foundation, but the $72 trillion wealth transfer thesis depends on whether that foundation translates into actual usage. The next few years determine if KASPA becomes the payment rail the analyst predicts, or remains a technically superior project that network effects leave behind. Digital gold versus digital silver. The generational wealth framework, positions Bitcoin as digital gold and KASPA as digital silver. This metaphor honestly captures their functional differences way better than those Bitcoin killer narratives that kind of miss out on how these two can actually complement each other. Gold is all about wealth preservation. You hold it long-term, and really you don't use it for your day-to-day transactions. Silver, on the other hand, works both as a store of value and as an industrial metal, so it sees a lot more transaction activity. In the same way, Bitcoin stands out as the crypto reserve asset, while KASPA is aiming to fill that medium of exchange role. This way of looking at things, well, it helps avoid direct competition. KASPA isn't out there trying to overtake Bitcoin's $1.3 trillion market cap as the digital gold standard. Instead, it's focusing on meeting the transaction throughput needs that Bitcoin's design just can't handle. Unless you add layer 2 solutions, which, honestly, bring back some of those trust issues people wanted to avoid in the first place. So, the $72 trillion wealth transfer, it really needs both. Bitcoin offers the stable reserve asset where generational wealth can park, And KASPA, well, it actually enables the movement, the thousands of daily transactions, the business payments, the merchant settlements, and all the DeFi interactions that this kind of wealth transfer generates. Historical precedent, honestly, supports complementary networks. The internet never needed just one protocol for everything. There's TCP/IP for transport, HTTP for the web, and SMTP for email, each one specialized for its own function. In the same way, crypto infrastructure might need Bitcoin for settlement finality and KASPA for transaction velocity. The big question is, will markets recognize this complementary positioning, or will Bitcoin's network effects and brand recognition just dominate, no matter the technical limitations? The generational wealth analyst thinks capacity constraints are going to force diversification. When Bitcoin fees hit $50 and confirmation times stretch into hours, people look for alternatives. KASPA steps in here, offering a proof-of-work option that keeps security principles intact while still delivering speed. So, to wrap things up, we've covered a lot of ground today. If you found this analysis helpful, I'd really appreciate it if you could share your thoughts in the comments below. And hey, if you want to stay ahead of the curve, don't forget to hit that like button and share this with your fellow crypto enthusiasts. Your support honestly helps keep this content coming. Before we conclude this analysis, make sure you're subscribed with notifications activated. I'm publishing a series titled Infrastructure for Wealth Transfer, which blockchains can handle institutional volume that expands on capacity analysis across multiple chains. That investigation reveals which networks have the throughput for real adoption versus those optimized for speculation. Don't miss positioning insights before capacity constraints become obvious to mainstream markets. Subscribe now. I genuinely appreciate each of you for engaging with this infrastructure-focused analysis. Your technical questions and capacity discussions push me to deliver research that evaluates what networks can physically process rather than what marketing promises. Remember, the largest wealth transfer in history demands infrastructure that can handle the volume. Bitcoin's role as digital gold remains secure, but its architecture cannot support the transaction velocity that trillions in daily movements require. Whether KASPA captures this medium of exchange opportunity depends on execution, adoption, and whether markets recognize capacity constraints before congestion forces the issue. The generational wealth thesis isn't about KASPA replacing Bitcoin. It's about KASPA serving the complementary function that Bitcoin's design cannot address. Position based on your conviction about whether speed eventually matters for wealth transfer infrastructure. This is TJ from TJ Crypto World, reminding you that the most valuable infrastructure plays are often those solving constraints that current market leaders cannot overcome. Keep researching, keep measuring capacity versus projected demand, and I'll see you in the next investigation, where we continue evaluating blockchain infrastructure through engineering constraints rather than market narratives.